Chill guy here, and I need 1 clean minute from you. The real shifts arrive quietly, then hit all at once. The media debates the Fed like a scoreboard. Physical markets move by shipments, inventories, and delivery dates. Silver has been tightening in the background. Premiums rose, lead times stretched, and in stock started meaning maybe. So the question was never charts. It was, who's absorbing real metal at scale? Follow the customs trail, not the commentators. Recent trade figures point to India, pulling roughly 5.9 B of silver in about 4 months. That's not a hobby. That's a supply event. Before we go deeper, hit like for signal over hype. And subscribe so you catch the next data drop. These windows close fast. Now add context. From 2013 through 2019, India averaged about 1.5 B of silver imports per year. 12 months, not 4. Today's pace compresses a year of demand into a quarter. Then it keeps running. That's how tight markets start. Quiet, then fast. Silver is global and finite, but it's not a deep ocean. A few large buyers can change the tide quickly. When that happens, price is only the first symptom. The bigger shock is availability across dealers, vaults, and exchanges. People will say, it's just jewelry season. Culture matters, but the math doesn't fit at this scale. A tighter explanation is industrial stockpiling plus investment demand. India is building, electrifying, and manufacturing more every year. Solar panels, grid hardware, connectors, sensors, and electronics all need silver. Remove the input and production stalls. That's when demand becomes price inelastic. Buyers stop haggling and start securing supply. Procurement thinks in uptime, not bargains. There's also the savings angle. When confidence wobbles, households prefer tangible value over paper promises. Across a huge population, that adds up. Policy can amplify the surge, too. Duties, reporting thresholds, and tax changes can pull purchases forward. That creates a rush effect in official data. And India isn't sourcing this from thin air. It draws from the same global pipeline the West relies on. That pipeline runs through refiners, trade hubs, and warehouse systems. Metal flows toward the strongest bid and the clearest need. Behind it all sits a structural gap. Many years, the world uses more silver than it mines. The difference gets patched with above-ground stock. That buffer exists, but it shrinks when multiple buyers lean together. That's why sell-offs struggle to stick. Paper can push quotes down, but physical demand catches the drop. In simple terms, India becomes a floor. Discounts on screens look like sales to buyers thinking in tons. Now, zoom out to Asia's pricing signals. Shanghai premiums are flashing the kind of stress screens can't hide. Reports show Shanghai printing triple-digit prices while the West hovers in the 90s. That's a split reality, not a rounding error. The spread has been cited around $11 per ounce at points. In silver, that's a siren. It's the market paying for certainty. Back in 2011, premiums near $7 were already considered system stress. Larger gaps suggest a deeper fracture today. A premium is the market saying, deliveries are scarce here. And scarcity in the world's factory echoes everywhere. Normally, arbitrage closes gaps quickly. Buy low, ship high, and the spread collapses. But it only works when bars can actually move. So if the spread persists, something is blocking flow. It can be logistics, financing, or policy. Shipping slots, insurance, compliance, and refinery capacity all matter. Small frictions stack into big delays. Delays create premiums that refuse to fade. Sticky premiums mean the pipeline isn't refilling fast enough. The metal is moving, but demand is moving faster. Now bring China into focus. China isn't only a buyer, it's a manufacturing engine that plans for inputs. When a material becomes strategic, it's treated like capacity. It's about building power, not scoring trades. That's why nations prefer exporting finished goods, not raw bars. You buy the panel or the device, not the metal. It becomes a one-way gate. Silver checks in, gets used or stored, and doesn't easily flow back out. China also sits on major refining capacity. If refined exports slow, the squeeze isn't local, it's global. This is where paper pricing looks fragile. A quote can move, but it can't summon a bar on demand. Add trade tension and de-risking to the mix. Every barrier adds friction, and friction is cost. Globalization optimized for cheap supply. The new era optimizes for secure supply, and secure is pricier. Redundancy replaces efficiency, and costs rise. Meanwhile, mining can't respond quickly. Much silver is byproduct output, and new projects take years. Even recycling can't scale overnight. So you get a calm chart with tight plumbing. And tight plumbing is where shocks turn into spikes. Watch the side signals. Lease rates, refinery premiums, and delivery queues. When they rise together, the system is strained. Markets also leave clues in local stocks. India's metals names have been outperforming, and that usually isn't random. Block 2. Start with India's Nifty Metal Index. When metals outrun the broad market, capital is rotating from stories into inputs. The ratio versus the main index has hit multi-year extremes in recent chatter. That's investors pricing scarcity, not optimism. Notice the timing problem. Money can chase miners today, but new ounces don't appear tomorrow. Supply is a slow movie. Demand is a headline. The lag creates pressure. Demand rises now. Supply follows later. In the gap, prices can overshoot and snap back hard. Now connect the dots. India pulls quantity, and Shanghai pays up for access. The cheapest market eventually feels gravity upward. That's basic physics in markets. A persistent premium is a magnet for supply. Gravity is the higher bid, and it pulls. Here's the trap for paper hubs. Push the quote down and you can widen the premium that pulls metal away. Each slam lower can look like a discount to physical buyers. The result is faster drain, not relief. That's why one global spot price can break. You get a screen price, a delivery price, and a restricted region price. In that world, the key number is all in cost. Premium plus shipping plus time is the real price. Now ask what China does when inputs tighten. Central planning doesn't just watch markets, it shapes access. Export licensing, tighter approvals, and quiet controls can slow outflows. No drama needed, just friction. Sometimes paperwork is policy in disguise. Combine that with high Asian premiums and you get a message. The highest bid is also the most protected. Manufacturers respond the same way everywhere. They hoard inventory, not for profit, but to keep lines running. That's why silver acts like two assets at once. It's a store of value and an industrial necessity. Solar is the headline driver, but it's broader. Data centers, EV electronics, medical devices, and power grids all rely on silver. Even tiny per-unit usage adds up at scale. Millions of units turn grams into tons fast. Supply, meanwhile, is slow and lumpy. Permits, capex, energy costs, and declining grades don't move on your schedule, so don't anchor on one candle. Anchor on the plumbing that decides whether metal can be sourced. Here's a boring framework you can track weekly. Boring beats reactive when volatility spikes. Pick a day, log the numbers, watch trends. Number 1, import and customs data. If big importers keep buying, the baseline demand model shifts upward. Number 2, regional premiums and spreads. When Asia bids far above the West, delivery tightness is real. Number 3, inventory and delivery signals. Exchange stocks, ETF flows, and wait times show stress before headlines do. Number 4, policy and trade friction. Tariffs, export approvals, and shipping constraints can reprice silver overnight. Strategy here isn't hero trading. Define your horizon so whipsaws don't steal your focus. Consistency beats adrenaline in tight markets. Separate price from access. Access is what industry pays for, and access gets tight suddenly. Access risk is what breaks forecasts. Expect a messy path. Sharp pops, fast pullbacks, and surprise squeezes are normal in a tug-of-war market. And if we approach the $100 headline level, expect emotion. Round numbers pull crowds, and crowds amplify swings. The disciplined move is to watch what's measurable. If premiums stay wide and inventories stay tight, pressure remains. Zoom out to the macro loop too. Trade friction raises costs, and higher costs feed inflation psychology. Central banks can move interest rates. They cannot manufacture ounces or override export bottlenecks. Rates don't unlock locked metal. In fact, tight money can slow mining investment. Less investment now can mean tighter supply later. So keep the core picture clear. India is absorbing volume, Asia is paying premiums, and flow is getting constrained. When metal tends to stay where it lands, the tradable pool shrinks. A smaller pool reacts harder to every shock. That's when the screen quote starts lagging reality. It may understate the cost of immediate delivery. Quick reality check. Compare the quote to dealer pricing. A widening gap is scarcity showing up in plain language. Second check. Listen to industrial behavior. Longer contracts and bigger inventories signal tightness that doesn't vanish overnight. Third check. Watch the calendar. Contract expiries and seasonal manufacturing ramps can create sudden sourcing stress. If you hold physical, you hold optionality. An ounce travels, a paper claim depends on a system. And if your goal is resilience, think in outcomes. Reduce high-cost debt, protect cash flow, and build durable assets. This channel stays on trade flows, premiums, and policy shifts. If you see copycats pushing nonsense, ignore them and stay anchored here. Hit like, subscribe, and share this with one calm friend. Then comment, staying with the original, so the algorithm knows where the real work lives. We'll keep tracking the physical signals as they update. Because in markets like this, the metal, not the microphone, sets the truth.